Hello, this is Leroy Meadows and welcome to this session. And in this session, we're going to do a third and final example of calculating variable and fixed manufacturing overhead. And this time we're going to apply it to preparing a four variance overhead analysis here. And that's what we'll see here in this table shortly. And then so let's go ahead and get started here. The Lopez Company uses standard costing in this manufacturing plant for auto parts. The standard cost of a particular auto part based on a denominator level of 4,000 output units per year. And when we see based on a denominator level of 4,000 output units, that's what our budget's going to be based on. So, including 6 machine hours of variable manufacturing overhead at $8 per hour, and 6 machine hours of fixed manufacturing overhead at $15 per hour. Actual output produced was 4,400 units. Variable manufacturing overhead incurred was $245,000. Fixed manufacturing overhead incurred was $373,000. Actual machine hours were 28,400. So let's go ahead and take a look here, and let's calculate our variable manufacturing overhead calculations first. So we're told here the actual cost incurred $245,000. So let's go ahead and put that in here. And let's just go ahead and format these cells. And I'll just do these two while I'm at it. Okay, so now let's go ahead and calculate our actual input quantity times the budgeted rate. So my allocation base was direct manufacturing labor hours, or machine hours rather, machine hours. How many machine hours did I actually use? Well, the problem tells me I used 28,400. And I'm going to multiply that by my budgeted rate. So 28,400 times my budgeted rate of $8 per direct labor hour. And I should come up with 227,200. Now, I want to figure out my flexible budget amount. So I'm going to take my budgeted rate and I'm going to take the number of hours it should have taken me to make those 4,400 parts. So let's go ahead here. We were based on 4,000 outputs per year, but we were told the actual output was 4,400. So I'm going to take my 4,400 and 4,400 units, and each unit took 6 machine hours. So I'll multiply that 4,400 times 6, and then take that result and multiply it by my overhead, variable manufacturing overhead allocation at $8 per hour. And I should get $211,200. So that's what I'm going to put right here. $211,200. And again, for variable cost, this is going to be the same as my flexible budget, $211,200. So let's go ahead and take a look here. Now the difference between my actual cost incurred and my actual input quantity times budgeted rate is going to be my spending variance. And what is my spending variance? Well, it's the difference between these two dollar amounts. And I actually spent more than what I should have based on my budgeted rate, so it's going to be unfavorable. And by how much? $17,800. And again, that is my spending variance. Now let's take a look at our efficiency variance. My efficiency variance is going to be the difference between my actual input quantity times budgeted rate and the flexible budget dollar amount. So what is my efficiency variance? It's going to be this number here, 227,200 minus 211,200. And let's take the difference there, 227,200 minus 211,200. And I should have a $16,000 unfavorable variance. And again, that is my efficiency variance. Now for variable overhead, do I ever have a production volume variance? No, I do not. So production volume variance, and there's never a variance. Not for variable manufacturing overhead. So what is my total flexible budget variance? My total flexible budget variance is, and we're just going to write this here, is going to be the netting together of the 17,800 and the 16,000. So when I do that, what do I get? Well, I'm going to add these two up together since they're both unfavorable, and I'm going to get a dollar amount of what, 17,000, or let's see, 33,800. So, and again, there's never a variance here. So this difference here between my actual costs incurred and the total difference between that and the amount allocated is going to be my over or under allocated variable costs. So was the difference between my actual costs incurred, 245,000, and the amount I allocated, 211,200. The difference there is 33,800. And that is unfavorable. And let me go ahead and mark that here. And this is my total variable overhead variance. Okay, so now let's take a look at fixed manufacturing overhead. And let's go by with the problem here. And what was my actual cost incurred? And let me just go ahead and format these appropriately. Thank you. What are my actual overhead costs? 373,000. Now, what was my static budget regardless of level of output? My static budget was what? Well, we're not given that amount. So we have to go back and figure this amount out since it's not given to us. So we're going to work backwards here. I am going to take my 4,000 units that I budgeted to make. So let's go ahead and take 4,000. And it told us in the problem that it takes 6 machine hours of fixed manufacturing overhead. So 4,000 units times 6 machine hours, and an allocation rate of $15 per machine hour. And I should have a static budget, or same budget and lump sum as in static budget, of $360,000. And my flexible budget is going to always be the same as my static budget when it comes to fixed overhead. So now let's take what we did and how much did we allocate? Well, I allocated $15 per hour per machine hour. So $15 per machine hour times 6 hours per machine times 6 machine hours per unit times the actual number of units produced, which was 4,400. And I should get an amount of $396,000, and I did that. So $396,000. So let's take a look here. What is my spending variance? My spending variance is simply the difference between my actual costs incurred and the flexible budget or the static budget, both same thing. And that was what, $13,000 unfavorable. And that is my spending variance. And remember, is there ever an efficiency variance with fixed overhead? No, because that relates to capacity, not how well we do use or don't use capacity. So that will be the production volume variance. So let's see, So it's 0 here. And we'll just say, actually, we'll just make it consistent, never to up front or up top, never a variance, efficiency variance. Now, what is my production volume variance? My production volume variance is simply the difference between the amount of my flexible budget of 360 and the amount I allocated based on budgeted input quantity allowed for actual output times the budgeted rate. So the difference here is what? 36,000. And that is favorable. Why? Because I allocated more than my flexible budget. So that's my production volume variance. And so what's my total flexible budget variance for fixed costs? $13,000 plus 0, since there's never an efficiency variance, is $13,000. And then I have my production volume variance of 36,000. So when I net these two, my production volume variance and my flexible budget variance, what do I get when I net these two? So since one's favorable and one's not, I want to take the larger one that's favorable in this case, $36,000, minus the $13,000 unfavorable for my flexible budget variance and I'm going to get $9,400. Is that right? 36,000. Oh, 3,600. Oops. 36,000 minus 13,000. And I should get $23,000 favorable variance here. And what does that $23,000 favorable variance represent? It represents overallocated fixed overhead. And this is also called my total fixed overhead variance. So now let's go ahead and plug in our numbers that we got from up here. Spending variance for variable manufacturing overhead was what? 17,800 unfavorable. And let's just and what was my efficiency variance we calculated up there? 16,000 unfavorable. So 16,000 unfavorable. And production volume variance, there's never a production volume variance with variable overhead. So never a variance. Now let's take a look at our fixed overhead. Our fixed manufacturing overhead, what was my spending variance? We figured that right out here, $13,000. And that was what? Unfavorable. Efficiency variance for fixed overhead, there's never an efficiency variance. And what was my production volume variance? I calculated up here, $36,000 favorable. So let's go ahead and put that in here. Okay, so this right here is my four variance overhead analysis. So and I have that here. In fact, I will change the color just a bit to make it stand out a little bit. There we go. Okay, so part 2 of the question asks to prepare journal entries using the four variance analysis. So using this information here and in the information in the problem, do my journal entries. So what am I going to do? Well, first of all, I'm going to handle the actual variable manufacturing overhead costs. And in this case, that was what? We were told $245,000. So I debit variable manufacturing overhead control, and credit the associated accounts payable in other accounts. The next journal entry I want to do is allocation of overhead. And how do I get my allocation of overhead? We computed that up here, $211,200. So I'm going to allocate that in the same way I would under job costing or process costing. Debit work in process control for the allocated for the amount we're adding to work in process, and we're crediting variable manufacturing overhead allocated. So now let's take a look at this entry. And what am I doing with this entry? I'm just simply closing out all my variable manufacturing overhead accounts. The overhead control, the overhead allocated, and my spending and efficiency variance. And when I do that, I'll be good to go with that. So now let's take a look at my fixed manufacturing. And here I am actually debiting fixed manufacturing overhead control for my actual cost of $373,000. And then I'm crediting wages payable control, accumulated depreciation control, etc., etc. So now I've journalized the incurrence of those fixed manufacturing overhead costs. Now I have to journalize the allocation of those costs. And again, whenever I allocate overhead, I'm going to debit work in process control and credit fixed manufacturing overhead, same thing as we saw before. But I'm going to get this number now because we're using standard costing. I'm going to get this from up here, $396,000. And when I do this table here, $396,000. And then I'm going to close out my fixed manufacturing overhead, allocated, control, spending variance, and production volume variance. So, and I'm going to use the numbers from up here, fixed manufacturing overhead allocated, same thing as what we allocated up here. I'm going to close it out. Fixed manufacturing overhead control, $373,000, my actual costs incurred. And then close out my variances here. And remember that unfavorable variance have what type? Is it a debit or credit entry? Well, that $13,000 is a debit entry. Unfavorable variances have a debit entry. Favorable variances have a credit entry. So even if you're not sure which side the variances should go under, whether it's a debit or credit, just remember that unfavorable gets debited and favorable gets credited. So now let's take a look here. So how are individual fixed manufacturing items controlled on a day-to-day basis? Well, by and large, they're not affected very much by on a day-to-day basis. That's because upper management have a long-term view of the company and their plans and their budgeting plans and so forth. So in this plan maybe have horizon 6 months, a year, or maybe even longer, especially when we're dealing with management salaries, taxes, and so forth. Things that we cannot control on the with lower level management. Now, what could be causing fixed manufacturing overhead variances? Well, it's realized costs differing from budget amounts. So our actual costs are coming in higher. And now some fixed costs are going to be known. Why? Because we entered into a contract for rent, insurance, but if something expires during the year and there might be a jump in costs, then that could happen. Some costs are going to be estimated. Managerial costs, as far as salaries, yes, but might there be other bonuses or payments not known at the beginning of the period? So that could definitely have an impact on fixed manufacturing overhead variances. Now, we also have an impact because in the long term, since we just mentioned that lower level management does not have any control over a lot of the fixed costs, one of those fixed cost variances is production volume variance, where we have either too many assets or not enough assets, or maybe we're just using those assets and we're running them a lot more. We're making more product per machine hour, what have you. So that production exceeded expected levels of output gives us that favorable production volume variance, since our output was greater than we had anticipated. And it was greater than the denominator level of what we used to allocate overhead, which was 4,000 machine hours. And we actually are 4,000 levels of output, and we actually had 4,400 levels of 44 units output and produced during the year. Okay, so again, this is our 4 variance analysis. We discussed a table here, like we did in exercise 1. Fixed manufacturing overhead table here, like we discussed in exercise 2. And then we combine that together to get our variance analysis. Now my total overhead variance analysis, what is that? Well, the total overhead analysis is simply the netting together of all these variances together. So my total overhead variance would be 17,800 unfavorable, 13,000 unfavorable, add to that 16,000 unfavorable, and then subtract 36,000 favorable from that. So we're netting together. What is my total spending variance? My total spending variance is going to be the sum of, or the netting together of, the spending variance between variable and fixed manufacturing overhead. So we're going to net those two together, and in this case, since they're both unfavorable, we'll add those. And that'll give me my total spending variance. My efficiency variance will always be the 16,000, or whatever the variable manufacturing overhead rate is, in this case $16,000. Why? Because fixed manufacturing overhead never has an efficiency variance. My total production volume variance will always be equal to the fixed manufacturing overhead production volume variance. Why? Because we never have a production volume variance with variable manufacturing overhead. And then we did our journal entries, and we actually were able to pull these from the table here, and it made computing our journal entries a lot easier and a lot faster. Okay, this is Leroy Meadows. I want to thank you for joining me this session. Have a good day.